Welcome back, everyone. Thank you very much for joining our panel today. I'm delighted to have three distinguished panelists. I'm delighted to have them because they know much more than I do about this field and will be able to give us a much deeper dive and with lots of insight. So you have the fuller descriptions of each of the panelists, but very briefly, Sandra Guerra. I've known Sandra for, I think, 26 years. She's a board member at Vale and other firms. She founded the IBGC, which is one of the great corporate governance groups in the world. It's in Brazil. You might have seen her extraordinarily insightful and frank interview in the last issue of the Hawkamah Journal. But her must-read new book is called The Black Box of Governance, Boards of Directors Revealed by Those Who Inhabit Them. And it was published in English just last month, so highly recommended. David Smith is a senior investment director based in Singapore at Aberdeen Standard Investments, where he leads ESG research and integration across Asia. Earlier, David headed Asia corporate governance research for ISS, and he must be one of the first people in the world to gain a PhD in corporate governance. I can't imagine there were too many before you, David. And then last but absolutely not least is Yu T, who's also a fellow member of the Hawkamah International Advisory Board. Delighted to work and serve with her. She's practiced as a lawyer in one of the biggest firms in Malaysia before joining Bursa Malaysia Berhad, one of the largest bourses in ASEAN. She spent some 20 years at the Bursa, including as head of enforcement before being appointed as the chief regulatory officer from 2017 to February 2020. And one of her key responsibilities, of course, was indeed corporate governance. So we're going to start off, if I might, by asking each of the panelists to respond to some of the comments that I made in the made earlier. But let me start off with questions to kind of help frame that, and I'll start with David, if I might. So, David, do you think, from an investor perspective, that Aberdeen Standard and other institutions, have changed practical approaches to ESG when it comes to portfolio companies? I mean, is stewardship today different compared to a few years ago? Do you expect different things from boards today?
Thanks, Dick. That's a good question. And firstly, you're too kind on the doctorate in governance. I figured if I chose a more esoteric field, it would be easier to pass, and it proved to be the case, so don't read too much into it. To the question on whether stewardship's changed, so yes and no, as you might expect. So no, in as much as the general expectations and thrust of our stewardship has remained the same from Aberdeen, and I'm sure it has for a number of our contemporaries as well. Yes, it has changed perhaps in terms of, as you alluded to, the practical implementation. So I think some of the things you mentioned in your comments were around, not just at Aberdeen, but across the industry more broadly, is a growing army of ESG analysts and fund managers looking at ESG. And so I think what we've seen at our firm and other firms, if you go back over the last decade or so, is a growing number of folks who are working on ESG and looking at these issues. I think on top of that, whereas conversations may be similar in terms of topic, we're supported by more data and analytics and science behind those conversations as we speak to companies. So 10 years ago, 15 years ago,
apologies for the interruption. David, please carry on.
Very good. Good to see everyone again. So where was I? Let's just recap what I was saying. So more resources, I think, for us and for a number of our contemporaries. The second point I would make is that there's probably more data and science and analytics to support the engagements we're doing. So although we're still discussing issues around climate change, for example, we now have the ability to put in a lot more scientifically supported data around either, for example, carbon footprints, but also things like climate scenario analysis, which we wouldn't have had 10, 15 years ago. So we're able to speak to companies and say, under these different technology policy scenarios, this is what might happen to the value of your firm. You know, that's not a tool that we necessarily had 10, 15 years ago. And so that's changed as well. I suspect that the breadth of topics that we're discussing and the interconnectivity of those topics has expanded a little bit over the last 10, 15 years as emerging issues have come to the fore. And so that's perhaps one change that we've seen in the industry. The final point, I don't know if this is true of the industry, but I suspect it is, and maybe it's just me, but I think that our engagements on a number of these issues have become more, how do I put this? Well, I would characterize our approach now as patiently impatient. So whereas we still understand that there is a natural course of engagement and we understand that change can take time, I think a lot of these issues are extremely pressing. And so there is now an expectation, I think, that boards have that insight, that approach to these big issues around, for example, climate change, but also around supply chain management, given the urgency of the issues and the materiality of these issues. So I guess to go back to the question, no real change to the kind of outcomes we're expecting, but yes, a lot of practical changes to the approach, I suppose, and to some extent, the urgency of the questions that we're asking companies.
Thank you, David. Appreciate that. And we'll get back to some of those points as well. Can I turn to Sandra from the board perspective? Do you think boards are fit for purpose given the new expectations that they face? And if not, you know, what can they do to best position themselves? And any other comments you might have about my earlier remarks?
Thank you, David. Thank you for the invitation. I'm very glad to be here with you today. Well, I think that the situation in regards to board and investors engagement is uneven around the world. I've seen this discussion started around 2006, 2007, when we both were at ICGN. And I noticed a big progress if comparing with the beginning in the North Hemisphere, let's particularly say US and UK. But around the rest of the world, I think that this practice did not evolve in the same manner. Speaking from my region, Latin America, and particularly Brazil, I would say that still very few companies understand the need of such engagement with investors. There is still the understanding that investors' relation is managed by the investors' relation function, and still even understanding this dialogue with the analysts, not the stewardship or ESG fellows in the funds. So in my other part of my life as a consultant, I visit many boards and I discuss this with them, listed companies in Brazil, big companies, mature companies in terms of, you know, in a certain way, governance-wise, although there is this prejudice that it's not to the board to dialogue with investors. So I think that there is an evolution. Investors are making themselves sometimes more present because let's put another thing. Investors are doing their role, and David, I think, did a very well explanation on the level of this, what is happening. But, you know, if you are in a market like ours, for instance, not necessarily investors would put all the effort and all the attention for the assets that they have down here. So they not necessarily are too active in regards to approaching the companies. Of course, big investors, which have very well structured departments to take care of this, are being more active, but the majority still are not, really pushing towards having this dialogue. And in the other side, you don't have boards with the understanding of the need of the dialogue. So we are in a beginning phase, but still you have companies starting to doing this and benefiting as well from this dialogue.
Yeah, that's pretty fascinating because, as you say, you have the market shifting, and David kind of explained how that is. But boards are having to grapple with it and understand what these changes are about and what the implications are. So I do want to get further into that during our session. We are fortunate, of course, to have in this panel an investor, a board member, and a former regulator. And so 3 different perspectives. So I want to turn to ET. Governments have clearly stepped in around the world to address ESG gaps in capital markets. Malaysia is one of the leading states that GCC countries might look to for ideas in this respect. And so maybe you could give us a summary of how Malaysia has acted to fill those missing pieces of ESG from the public policy perspectives. What have regulators there done to promote greater adoption of ESG among key stakeholders?
Thank you, Stephen. If you don't mind, could you bring out the slide, please? And good day to all. Okay, let me just start off with this one slide that basically shows the regulatory journey of Malaysia in nudging our market along in terms of adoption of ESG. Just wanted to highlight also basically what Stephen has highlighted earlier in his opening just now. As you can see, in terms of governance, you see that the track is earlier in terms of the history to it. It started off from 1998 in Malaysia, but when it comes to sustainability, you see that it is at a very nascent stage. So this is where we call it the missing link of ENS. Governance is not an issue. 1998 governance was in terms of the initiatives to push corporate governance along has started as early as 1998 at the government level even, where we came out with our first corporate code of corporate governance. And this is where we mandate reporting by our listed companies premised on comply or explain. Okay. But you will see in 2006, and this is where you will notice as well the UNPRI, when it was first launched, you have 63 signatories. But as you move along in the years 2019, you see now there's more than 2,500 signatories. So this is where that misconception, if I can put it, that when it comes to sustainability, it is ethical investing. You need then to sacrifice returns, financial returns, to take on that social responsibility. And a regulator is no different. That lack of clarity and also the market readiness, we started off with the corporate social responsibility framework. So whether that sort of reinforced that ethical investing or not, I'm not sure. So we started off with that in terms of looking at readiness of companies as well, just to push it along. But in terms of corporate governance, you'll see that we've come up with second edition, we come up with guidance. So it moved along in terms of maturity of corporate governance. Only in 2015, when the UN came up with the SDGs, the 17 areas or goals that are being looked at, we then mandate sustainability reporting amongst our listed companies. And this is where we come up with guidance, we come up with toolkits, we come up with various training programs to educate the companies, because it is still an abstract concept as to sustainability reporting means that there is a correlation, positive correlation to financial returns, positive financial returns. So the education needs to take place. And this is where we also came out with a portal, a one-stop portal where all the sustainability case studies, all the empirical studies, data are all put there so that listed companies can go there and be able to understand and hopefully greater conviction as to the adoption of sustainability. Moving along 2016 and 2021, you see that we have further revised our Code of Corporate Governance. And this is where, instead of comply or explain, we took a divergence. And this is where the harder regulation comes in, where we impose and mandate companies to apply the best practices. And if you cannot, you need to explain an alternative practice to meet that intended outcome. Now, if you look at it and recent findings like the OECD, if you look at the OECD Corporate Governance Factbook 2021, out of a survey of about 50 companies, of which all took on the comply or explain approach, Malaysia is one of it that sort of like deviate from that, where we introduce a harder regulation. So this is where I just reinforce Stefan's views that there is greater maturity, I believe, in Asian countries in terms of the G element, but E and S is still at the nascent stage. And this is where we came up with a Malaysian code for institutional investors. We are actually one of the first in the ASEAN country and second after Japan when we introduced this code in 2014. And a year later, we sort of spearheaded the establishment of the Institutional Investor Council. Yeah, and to date, there are 35 signatories consisting of all our government-linked investment companies, as well as the Sovereign Wealth Fund. Yeah, so this is where it provides that impetus to further strengthen and nudge our companies towards greater adoption of sustainability. Yeah, with, I suppose, size does matter. So with that, I'm just going to stop here, Stefan.
Thank you. Thank you so much, E.T. That really is quite an extraordinary roadmap for public policy as GCC member states begin to think about their next steps. I'm also glad you mentioned the OECD, which is a great resource, not just for Asia, but also for the MENA area. I know we have Fiona Jordan has been involved in that as watching our call today, along with many others. So it's a great resource. Thank you. Can I, before we go on to some other comments, I just want to remind everyone that we would be delighted, we would welcome your questions. So feel free to insert them into the chat. We already have some, and I want to get to those in a few minutes. But first, if I could say, I'd like us to move from the abstract. We're talking maybe a little bit abstractly about these issues, but of course, board members and others in the capital market have to deal with day-to-day issues. I'd like to ask each of the panelists to give us a practical illustration about how ESG has affected their worlds and adapted. So can I just start with Sandra? Sandra and I had a good conversation about Vale. I don't know if you wanted to talk about that as the example, but can you give us an example from the board perspective about how these missing pieces of the ESG play a role?
Yeah, thank you, Stephen. Yes, and of course I can talk about the example of Vale, where I was a board director until May this year. The interaction with investors in Vale would be, until a certain period that I will mention, solely organized and executed by the investors relations function. The CEO and the C-suite would be involved with that. And then the company faced the tailing dam collapsed at the Córrego do Feijão iron ore mine in Brumadinho, in the Brazilian state of Minas Gerais. This was back in January 2019. and the resulting mud flow killed some 270 people. Most of them were Vale employees and family members. As you are all familiar, because it was covered internationally, the disaster was an existential one for the company, and Vale confronted sudden daunting regulatory, reputational, financial and operation consequences that even threatened the firm's survival. Executives faced criminal charges, and the company agreed to a $7 billion settlement, the largest one in Brazil history. So all this situation triggered discussions and reactions, and of course the board was pretty much involved in the very first day in the management of this crisis, from creating independent consulting committees to the board to deal with the quickly as events unfolded, to the immediate suspension of variable compensation and dividends that later on were resumed. And, it's an infinite list of items that the board would take care. But one of the main issues would be the credibility that was lost from the company and the resulting damaged reputation. And at this moment in time, this situation triggered the company and the board to be, let's say, more open to the possibility of having the dialogue from the board and investors dialogue for the first time in the history of the company, talking with international investors, institutional investors. I was the one receiving delegation from the board to be engaged with investors. And I had several group meetings, individual meetings throughout 2 years, always covering ESG factors, and particularly, the conversation would be pretty much about, the culture transformation project of the company, all the actions related to the reparation for the ones that were involved in the environment, including economic, social, and environment, and all the approach to risk and to the operations and many other related topics. And I can witness here that it was very, very important to receive this feedback directly from investors, because it brings much more vivid and colorful perspective from outside the company that helps to guide the board into very difficult decisions that we face throughout this. I experienced at least 2 years and a half of very, very tough decisions. So understanding the perspectives directly from investors was very key, to help the board to make these decisions. And the other way around, it's better to investors to having a inner perspective of the decision-making process. So what was being done, the other stakeholders that we are taking care and dealing with their perspectives as well. So I think that, when you experience as a board a situation like that, if you are not convinced that this dialogue is productive, this would be your last day without not understanding the beauty and the value of such engagement and dialogue. It's enriching, it's a learning process, and it's even to investors to understand why things sometimes take more time, because they are following. And I would have, let's say, 3 meetings in a year with the same investors, the same fund, So they keep track on what is happening. It's very, very constructive process to companies to engage in such dialogue. And sometimes problems would trigger the boards to be more open to this possibility.
Thank you, Sandra. It's very vivid and insights from a very tragic story that occurred in Brazil at that time. And to me, the interesting takeaway is that that if companies engage with investors and understand their ESG concerns, then you can build goodwill that you can tap in a crisis such as that. In Vale's case, you had to do it sort of following the crisis, and so learn those lessons the hard way. But the other takeaway I have from your remarks is that the board was smart enough to have someone such as your good self playing that role. In other words, someone on the board in particular was given the job of engaging with investors and bringing those conversations back to the rest of the board. So I appreciate that very much. E.T., can I turn to you? I think there's a case that you were involved with, Top Glove Corporation. Can you give us a sense about how that worked?
Yeah, sure, Stefan. I think this is a good case, lessons learned in terms of the expectation that companies should move beyond box ticking and window dressing. Yeah, regulation is there in terms of sustainability reporting, where expectation is for the board of directors to address ESG integration vis-a-vis material areas of which provide risks and opportunities towards creation of sustainability. In fact, this company was also engaged by the institutional investors, the council, back in 2018. And the issue, I believe, includes sustainability and specifically the labor. Yeah. And when the pandemic comes in, it was in a very sweet spot because this is the top or the largest glove manufacturing company. So it was earning a lot because everybody was basically demanding gloves, right? So it was earning about, in terms of its profit, 22 times that 6 months in February 2020. And sales was about increase of 315%. So as far as the business fundamentals, it was very positive in the light of the type of business it was in, but it was dragged down because of ESG. Okay, what happened was the news come out about labor abuse, how they mistreated the employees, and that resulted in a ban by the United States because of these issues, and that sort of curbed the ability for them to maximize their revenue during this time. Yeah. And because of that situation that they were in, thousands of their workers got infected with COVID. So that further reduced the productivity in terms of producing the gloves. So as a result, they didn't manage to address it in 2020. 2021, it further exacerbated. There were further bans of its products by the US Custom. And that gave rise to a very volatile pricing of the shares. 52 weeks, it was a jump of about 6 times, from as high as in US dollar $2.40 down to 40 cents. Yeah, and what happened this year in June, when the stock exchange reviewed the FTSE4Good index, they were removed from these 3 indexes. Okay, so that further exacerbated the downward pressure to their share price. So in terms of the share valuation, it was depressed further. And this year as well, what happened was we see shareholder activism. BlackRock actually voted against the re-election of the 6 directors. Okay, so what they're grappling now is to repair the damage in terms of the green credentials, and target price has been given lower PE because all these issues and the perception of the company in relation to ESG. So this is where, again, like I said, whilst regulation may be there could be institutional investors engaging and all that. At the end of the day, that adoption or expectation on companies, that conviction as to the ESG integration. You know, it's like I say, it's not a box ticking exercise just to get ESG ratings, but looking at the proper integration of all these factors towards, again, like I said, long-term value creation. Thanks, Stephen.
That's such a fascinating example, and I think it goes to the point that these were avoidable problems.
Yep.
From what you describe, and what was missing was, it seems to me, a board or the shareholders, controlling shareholders, that really just did not have eyes on the ESG risks that the company faced, and as a result, they took a tumble. But it was avoidable.
Yeah,
and there are ways, and so boards need to kind of take some of the lessons that Sandra had mentioned earlier. If they had dialogue, if they had eyesight, if they were able to bring some of these insights into the board, it could have prevented some of the issues that the company faced.
Yeah.
So thank you for that. David, can you, from an investor perspective, can you give us a case that we can learn from?
Yeah, well, sadly, I can't give specific examples of companies as an investor, but I can tell you the kind of thing that we're looking at the moment, where we're seeing very clear differentials for the benefits or cost that ESG awareness can bring. We're spending a lot of our time at the moment focusing on supply chain management and labor management, and I want to pick up on the point that ET was making, because this has impacted the Malaysian glove manufacturers, for example. But I think what we're seeing now within this region, and this may be helpful for some of the corporates we're watching, is the ability of corporates that we are owning or looking at to use supply chain management and or labor management as a competitive advantage. So given the ability to trace components down a supply chain and be able to say with confidence that there's no forced labor in our supply chain, there's no risks of any other environmental damage or social issues in a supply chain, then I think we're seeing that companies will be able to use that to gain market share. So this is true within the renewable space. We've heard about the discussions around polysilicon, for example, in China. This is true in the garment space, where we're looking at traceability down the supply chain towards the cotton, for example. We're seeing this in component manufacturing. So, you know, the folks that assemble iPhones, for example, we're seeing this in glove manufacturing in Malaysia, for example, and we're seeing this in a range of industries. And so companies are able to say, yes, we audit second degree, third degree supply chain. Yes, we can say confidently that there's no forced labor in our supply chain. And yes, we can configure supply chains to your wish. Is something that companies have been able to exploit, as I mentioned earlier, as a competitive advantage. As an investor, what we've tried to do is pull together the perspectives that we might have in Western Europe or North America, for example, where some of our portfolio companies are at the B2C end of the supply chain, along with the emerging markets perspective, and particularly in some of our Asian companies, where maybe some of our companies are further up the supply chain and say, look, this is what we're hearing from the end consumer electronics company, for example. How are you adapting your own supply chain to fit into their own audit expectations? And so, apologies, whilst I can't mention specific companies, I think what I've spoken to echoes the comments that ET has made, that companies that are able to adapt to these requests and have that very clear insight into their supply chain, and the data around that are those that are going to enjoy a competitive advantage. And on the flip side, those that can't, and where boards haven't been on top of these issues, are the ones that will be challenged going forward.
David, just so we are crystal clear, when Aberdeen Standard, as an example, engages with a company board or management, do you raise the issue of human capital management, supply chain, how employees are treated, the issues, for instance, that ET mentioned in respect of a glove company?
All the time. And again, that's not because we think it's a sort of a nice to have, but because there's a very clear and present risk to a company's business model, frankly, that if something comes up from a supply chain, that there's something in a tier 2 supplier who's doing something that they shouldn't, then that's a very clear risk to the sustainability of your business model. And to us, that's what sustainability is about, your ability to continue to survive and thrive as a business. So all the time, that's a key part of our due diligence.
So it's very much a part of the agenda for discussion when you're talking to a board. But can I then take the next step, which is to say, if a company tells you everything is under control, we're fine, do you bring now new metrics or independent research to bear to sort of check whether this is accurate or not?
Yeah, it's a good question. Obviously, as investors, you always want more information and more data. To some extent, there's a limit to what we can get, but we can try and triangulate. So as I said, we may own companies at different points of the supply chain. We may own competitors in different markets, for example. We may want to work with third parties. We may work with specialist research agencies that can give us insights into a sector or a geography. And so you try and triangulate as much as you can. And in some cases where we've tried to get comfort on forced labor in a specific industry, you can do your work along the supply chain, but we've wanted to have conversations with engineers, for example, in that sector to say, if you look at where the likelihood of forced labor is, it tends to be in fairly commoditized processes, right, rather than highly skilled processes. And so we've spoken to engineers or specialist consultants to say, within the skill set that's required for this particular sector and for this particular part of the value chain, how likely to you do you think it is that we would see forced labor? Is this something that relies on large pools of labor, or is this something that requires on folks with advanced degree holders, for example, because it's more of a scientific endeavor? So it's oftentimes quite difficult to get a sort of a verifiable yes, no, but you can build that sort of mosaic that helps you get comfort or not. In some cases, you get sort of 50% comfort. In some cases, you get 80% comfort. And there are cases where we feel okay. Maybe you like the business, you feel okay, but if you still have doubts, if you can't comprehensively say no, we think that everything checks out, then you just step away, because it's not a risk that we want to take for our clients.
And this is where I think there's been such a difference, because now you may, I mean, a few years ago, you wouldn't have had much research at all that you could have tapped, but now there are NGOs that are on these issues. There are consultancies that are offering data. So your options are expanding, almost by the day. Sandra, were you going to say something?
Yes, I thank you so much for noticing. I was wondering, and I would like to pose a question to David, because sometimes, I see a huge progress on having so many indicators, so many methodologies to track the progress in all these ESG fronts. But at the same time, I think that this could be, in a way or another, a bit misleading if you only count with that. What I'm saying here, I mean, you may have indicators, you may have numbers, but when you don't have a transformation in culture, I'm not too confident on the indicators. I mean, sometimes you have percentages of reaching things, and of course one may say, well, numbers don't lie, but I would say numbers not necessarily tells the whole truth. So how much effort are investors putting in understanding the culture that would lead to better ESG practices?
Well, Thanks, Sandra. And I feel a little bit embarrassed because you've kind of set me up for an answer here that speaks to what we do, but it's absolutely the right question. I tend to be quite skeptical of numbers, well, for a number of reasons. So when we speak to companies, and I did this just today, actually, we tend to ask around the processes around sort of human capital management, supply chain management, and so on and so forth. But if we've got a conversation with, let's say it's a head of supply chain or a head of sustainability or whatever, then we tend to ask more about both the firm governance structure around sustainability, but also the softer questions as well. So A, who do you report to? Who do they report to? What is the flow of accountabilities and reporting? B, what kind of airtime do you get with the CEO and the board? So how often do you speak to the board, for example, and what kind of questions they ask you? And C, really, who in the firm is the sponsor of what you're doing? And that's really, really important, that the people who are charged with making sure that things work, that they're walking the walk in terms of what we're talking about, tend to need to have a sponsor, and that sponsor needs to be the chairman or the CEO. So we tend to ask the sort of firm governance questions, but also the softer culture questions, and also who the sponsor is. And sometimes, in the case of the engagement I had just today, it was very clear that it was the chairman who was the sponsor of everything, and the chairman therefore ensured that this was discussed at the board regularly, that this was cascaded down to management KPIs and compensation, and that's really, really important, frankly, and that cascaded down the organization. There have been engagements we had where you're having a good conversation, you say, well, how much airtime do you get with the board? And then someone will say, well, the board just meets quarterly. They just want to stamp the numbers. They're not interested in this. We just get up to the sort of divisional head. The board and C-suite don't really discuss these issues. And then that puts a very different complexion on the conversation. So I agree with you completely. Numbers are important, verification is important, but really knowing how embedded this is in the culture and the ethos of the firm is really what makes the difference. And frankly, as an analyst, as a fund manager, what helps me sleep a little bit better at night.
Yeah, thank you for that exchange, because I think what it demonstrates also for our audience is how much more sophisticated this engagement process now is. What are the questions now being placed to boards that they're going to have to be answering that they wouldn't have had to address in the past? So I think that's great. Can we turn before, I have other questions, but let's turn, if we might, to one of the questions that's been put to us from the audience, which is, has there been an actual change in linking ESG to executive remuneration? So from the company side or the regulatory side or the investor side, who would, anyone want to tackle that one?
I can start it off. Sorry, Sandra, you want to go
No,
ahead?
go ahead, Eugene. Go ahead.
Okay, sorry. Well, I made mention about our Malaysian, the 5th edition Code of Corporate Governance. And this is where we enhance further in terms of our expectation on board, in terms of linking ESG integration, and as well as the outcome vis-a-vis compensation and remuneration. Okay, so now companies in Malaysia moving forward, they would now need to make that kind of reporting to the market. As to the effectiveness and whatnot, that is something that we will be monitoring. But I believe by making companies and the board addressing this specific factor and disclosing it, it would draw the attention of the market, and that would include the shareholders. So there is that expectation vis-a-vis the mounting regulatory pressure, and hopefully, if not all, at least it's a starting of a journey to make sure that everybody addresses their mind to it. Yeah.
Sandra, did you?
Yeah, I think there is an important progress here. And again, in the same case I was covering before, there was important changes in regards to compensation, not only in defining what would be, the long-term incentives or the ESG goals related to compensation, but also to adopting mechanisms such as malus, clawbacks clauses where, it's clear that, you may produce the better result in economic results in the company, but if you do so menacing other elements, you will not, as an executive, getting, your best compensation. But I think it's very tricky because you can have a compensation, and I've been in compensation committees, which we call people and governance committee back then, and now people, compensation and governance. You can have a very good model, you can have the mechanisms, you can have the proper share between short and long-term value and everything. But what is very difficult to board directors is to design the goals. You may say, why is that? It's how do you write the goals? It has to be very clear. And you learn that was not clear 1 year later, when you have to decide if you're going to pay or not that portion of the variable compensation. You say, it's not clear if, the boundaries of the goals were not clear. So this is a very important exercise that companies and boards should put, efforts and time to define very well the goals. And for that, the dialogue with investors is essential.
Thank you, David. Do you want to add to this?
Very briefly, because I can see a ton of questions coming in. It's starting in Asia. It's starting more in developed Asia than emerging Asia, and it's starting more in the larger companies than the smaller companies, as you might expect.
And there is a question. Do you from the audience? Do you question the board on executive compensation when you engage with the board as an investor?
Yeah, all the time, and that's really just because as human behavior tells us, what you incentivize people on tends to be what happens. And so if you incentivize someone to grow revenue, then they grow revenue. If you incentivize someone to grow market share, they grow market share. And so we want to make sure that our objectives as long-term investors are aligned with a remuneration scheme that rewards long-term sustainable value creation.
Thank you, David. We have, as you mentioned, a ton of questions coming in, which is very welcome indeed. And maybe I'd ask one that just arrived, which is how important is ESG to improve credit ratings? I'm not sure we have a good fix on that, because a lot of the credit rating decision making is sort of a black box at among those firms. But has there been any experience that people have on that?
Well, in the very same case that we are covering before, Stephen, right after the disaster, credit ratings where we are assessing the companies again and and rethinking their ratings in regards precisely to the conditions that the at some time faced in the very beginning, an existence risk, because when you don't have trust around you, it's very difficult to move on, to say the least. So again, it was very important to have the dialogue. The other independent director and me, we have conversations with credit ratings at some point, and they have assessing all the company, talking with executives and talking with us to understand what is coming from what would be our reaction, and they decided to maintain the rating of the company. So again, the dialogue is not only with investors that the board would do, particularly in a crisis period. And I understand the ESG is becoming more, the awareness of credit ratings are becoming more aware to ESG topics.
Yeah, I remember that from our conversation that you and the other independent director were in touch with credit rating agencies. And that's another, very interesting, and I think it would make some companies rather nervous to have certain board members doing that, but it worked for Valet. Let me ask one question that's been put to us also. It's kind of a broad question, but for a company that is new to E&S, what is a good place to start? It's a big question, but anybody want to?
Happy to take that unless
ahead,
my
David.
colleagues want to go first. I think the best way to start, really the simplest way to start, is to think about the business itself, both in terms of the sector or the industry that the company is operating in, the geographies that the company is operating in, for example, and then really think hard about what the most material issues are for your company in terms of E&S issues. Now, those will be different for different companies and different sectors in different geographies, given the context there. But if a company can start by mapping out those most material issues that are most likely to impact the long-term financial performance of a company and all that goes with it, then that's a really good place to start. And if after that process you can identify a number of high impact issues, and that need not be 20, 4, 5, 6 most material issues, then set about measuring performance on those issues and strategies for improving performance on those issues, then I think that's a really great place to start.
Let me, go ahead, UT, go ahead.
Sorry, if I may just add on, I agree with David, but all these are big words to a company that's new to E&S. So I suppose for me, they should start off with equipping themselves with the knowledge. And this is where the board should look at whether the composition of the board is able to take on the company to move on to their sustainability agenda. Should they get somebody to come in to sit on the board who is very well knowledgeable in this area, and they may also look at upscaling of the resources or the people that they have. And this is where they may need to get or get in touch with third parties, consultant and whatnot. So I'm looking at basically education and training for a start before you go on to that journey, as what David has mentioned.
And
Yeah,
UT,
If I may complement this, I think it's a very good place to.
Oh, Sandra,
is with defining the purpose. The purpose should be in the center of everything. And I think that the ISO 37000 clears this very well. The purpose is in the center. If you have the purpose, everything will grow from the purpose. And I would say the boards are not necessarily involved enough in the purpose discussion and definition.
and Sandra, isn't that an ET too? Isn't that a particular challenge when you have a family-controlled company?
So it goes back to what Sandra said, the purpose, the conviction to move on. And this is where I suppose there is enough data to show that positive correlation between ESG with positive financial returns. So everybody follows the money, right? So for family-owned companies, if they're looking at long-term, and that is always the case with family-owned companies, they want that legacy of their business to continue, they will take it on.
Yeah, and I know I would not necessarily say, Stephen, that it's more challenging for family control or family-owned companies. Quite the contrary. I may remember, now that you're mentioning so many cases of family control owned company, the purpose is clearer in a family-owned company because of the legacy. So, the engagement with community, for instance, can be clear. Of course, not necessarily. The G part is eventually more challenging in family-owned companies, but the environment, social, not as a rule, but you can find the awareness of families could be higher than, in true corporation, where it's not material. It's not that material. To the companies, it's material. There are employees that are there for 30 years, the relation with the community, the legacy for their family. So it's a very good place to start. Again, purpose.
Yeah, and I agree with you. But what I meant about the family companies is that it may be difficult to seed information to, especially to independent directors or to outside investors or outside parties. But I agree, as family companies are maybe much better at purpose than perhaps public companies. David, any last comments? Because I think we're almost out of time.
No, I would echo what UT and Sandra say, frankly. We like investing in family companies for that long-term and purpose perspective. And as UT says, people tend to follow the money. So we wrote a paper earlier this year that's on our website summarizing that link between ESG and performance that we found is extremely helpful in gaining that mind share in terms of the reasons for doing this.
Well, with that, I think that's a great note for us too. And I'm delighted that we had this opportunity to share comments and insights. I want to thank my panelists for their great contributions. And I think this may be the first panel I've ever been on where no one has had to be reminded to get off of mute. So I think that's a great achievement that we've all made. So anyway, thank you, everyone. Thank you to our audience for the big pile of questions. I'm sorry we couldn't get to everything, but again, thank you very much to everyone. Have a good day.
Thank you, Stephen.
Thank you so much.
Bye.
Bye-bye.